evening and welcome once again to the weekend edition. So good to be back with you. Probably one of the most up and down, topsy-turvy weeks that we have seen in the market in a very, very long time. So you can be sure we've got a lot to talk about. In a nutshell, government shutdown over, markets seem to like it, but then some very hawkish Fed comments between Thursday and Friday knocked the futures down really big overnight. But then, of course, reversal. The buy the dip mentality apparently is still with it. So I got so much to share with you. Very excited to be with you once again. As always, more charts, less talk. Let's do it. Well, let's take a look back at the week that we just had. Remember in the introduction, I was talking about the topsy-turvy nature of this week. Lots of two-sided trade, big reversals, and a lot of that was due to the ruling reasons here. This is sort of the color that I apply to the technicals each week in the show. We start out with the ruling reasons of what the big headlines were that were driving the market. Basically on Monday, there was a large true gap higher, adding on to that Friday optimism of the government reopening. If you recall from last week's program, and if you're watching the charts every moment like I am, November 7th, on Friday was the large reversal that closed strong. So Monday was basically just an add-on to that. Wednesday, we had some positive news from AMD. They sort of energized the AI trade a little bit. They had some growth projections that were positive at their Investor Day conference. And here's where things get a little bit switched up. On Thursday is when the actual government shutdown officially ended, if you will, because the House had their vote. But Collins, FOMC member, said, quote unquote, it was appropriate to hold rates where they were. And then we got a little bit more hawkish commentary from the Fed coming into Friday morning. That was the big gap down where we downshifted the December rate cut expectations. We are now, I think, sub 50% for a cut at that December meeting. And this is kind of a big deal because we've been doing Fed Watch on this program for a while. I'm not going to do it today, but when you get a moment, check out that CME Group Fed Watch tool and be watching very closely between now and that meeting in December as what those odds are, because we are now sub 50%. That means there's less than half chance that the Fed is actually going to even move on Friday. And that's what caused the huge gap down this morning on Friday the 14th. However, apparently the buy the dip mentality is still alive and well, because usually on a large gap down, you do one thing. You play for the gap fill and you do the classic when what should happen doesn't, meaning you're either going to gap fill or you're not. And that's the thing. And today, not only did we gap fill, but we went deep up into range. So when I get into the next segment, we're going to get very deep into the charts. I'm going to add on futures charts on top of the cash market charts for you to see how we were moving pre-market and into the rest of the day, because it's really, really fascinating. All right. Let's move over to the numbers here and see how everything I just talked about translated. And once again, this seems to be a recurring theme every week. It's all about the rotation. Once again, because when you look at this screen of the percentage change, net gain or net loss from the open, always from Monday's open to Friday's close, of not only the majors, but more importantly, the 11 sectors that make up the S&P, there should be one thing that jumps out at you, and it should be right here, healthcare, right? You know this market was down over the course of the week. S&P ended up from Monday to Friday down about 0.75%. NASDAQ a little bit weaker, right? Obviously, that tech trade cuts both ways. When it's running, the leverage works for you. When it's falling, the leverage works against you, right? And Russell down about 2.5 as well. That makes sense, right? If there's expectations of rate cuts lowered, then the more interest rate sensitive Russell is going to fall. But within the S&P 500, always made up of these 11 sectors, right? Most important thing, look at healthcare, up 4% on the week. And this really speaks to the rotation. And that's why the market is doing what it's doing. It's very, very wild. And the reason that it's very, very wild is because the moves up don't have all sectors participating. Whatever is going up is coming out of somewhere else. And when the market is coming down, it's not money coming out of the whole market. It's coming out of technology and it's going other places. And we saw that this week with healthcare, energy, and staples, right? So very, very rotational market continues. Number one thing I want you guys to remember is that if it's going to go down and stay down, everything's being like baby with the bathwater thrown out, right? All of the sectors will be red from Monday to Friday. That's what you're going to see. But for right now, we still have a very rotational market. All right, bonds didn't move much. Yields didn't move much. No big deal there. VIX obviously up a little bit because it had a little bit increase in vol. Gold, very interesting this week because Friday's move, obviously, if we are taking the rate cut expectations down, yellow metal reacts negatively, which makes perfect sense. Crude down back under 60. I always say, sub 60, potential opportunity. That's all there is to it. It doesn't remain sub 60 very long, so keep an eye on it. And Bitcoin, which we're going to talk about in detail later in the program, lost almost 10% on the week. And more importantly, look at the closing value, 94.9. So the 100 floor is no longer the floor. Now it could be the ceiling if we were to rally back up. Later in the program, I'm going to get a little bit deeper into the Bitcoin chart for you. Now for what I like to call the most important part of the program, where we look at the charts and see how all those ruling reasons played out in the technicals, which is of course the most important thing for everybody to know about. Let's take a look at the S&P daily. Lots going on here as far as trend lines. I've added one extra little thing to this chart that we haven't seen before, at least not for me. I haven't been using simple moving averages for a while, but I put a 50 on it. And the reason I put a 50 on it is because obviously institutions look at the 50. I know it's important. I'm more of a 821 EMA guy as of the last couple of years, but I did want to show you the 50 because look at the price action, how you had the November 7th reversal and the November 14th bar, and look at how they both pierced the 50, but neither of them were able to close below the 50. This is kind of noteworthy, very, very interesting. And then of course the trend line is here going back on the daily chart. Look at how you have trend line break midweek and then failure, didn't make it to the all-time high, so this is important. Carry that forward, that now, even though we rallied so hard on Friday, we are working with a lower high, and that's important, right? For now, we do have a lower high. So I think what's going to be very key going into next week is, can we take out this Wednesday move here, right where we were cresting around the 6860 in the S&P? If we can't get over that, we may see some more downward action. Let's see how this looks in the NDX. All right, NDX daily chart, similar, but I think we went a little bit deeper here on a double bottom, lower than the 50, and we didn't rally really as much in terms of getting up and over the 50, but the situation with the trend lines is the same. The downtrend here was broken. One of the things I think in the NDX that may have been a clue in terms of weakness here is the fact that when the NDX did the trend line break here, notice that the action was very sideways. The 8 EMA, which is the yellow line, it didn't really budge. You just got straight sideways action, and then once you fell out of that on Thursday, coming below that sort of 3-day balance, that's all that it needed. So I think the key levels in the NASDAQ 100 coming into next week is going to see, can the market get back up to that 3-day balance? But more importantly, we've talked a little bit about the pinch here on the show, which is of course very, very important because it is the longer term signal on the daily charts in terms of trend. And we are close to getting the pinch here on the 821 on the NASDAQ 100, right? Notice the yellow line is the 8. The blue line is the 21 EMA, and they are literally just starting to touch like that. We do not have an official pinch yet because we have to have a close of the faster moving average below the slower one, but it's almost happening. So this is going to be kind of important, to be honest with you. It's kind of a big deal. I know it seems very simple, stupid, but you know me, I like to keep my TA very simple as possible. Couple moving averages, that's it. No indicators. I don't like any of that stuff. Just keep it simple. If we get daily bars that close in a manner where you have this pinch, that is going to be a little bit bearish going forward. All right, now let's take a look at some weeklies. We don't talk about weeklies that often on the program, but I thought it was noteworthy to talk about weeklies today because I just wanted to illustrate the sort of two-sided action and how little we haven't moved, right? Look at the weekly bar here in the S&P. One takeaway is it's an inside bar, right? All of the activity of this week was inside of the activity of last week. So thereby confirming we didn't do all that much, right? Let's look at the NDX. Similar thing on the weekly, right? Except the only difference is you took out last week's low in the NDX. But again, look at the range. Mostly inside of last week on the NDX. All right, now let's look at futures for a second because here's where things get a little bit different in terms of how it's laid out on the charts because of the 24-hour nature, right? Obviously, the charts that we just went through, which are S&P and NASDAQ, dailies and weeklies, those charts are what we call RTH charts. That stands for regular trading hours. That's 9:30 to 4 p.m. Eastern time. But these also the same time zone, but they are 24 hours, and that's why the candles are bigger. And a lot of times, especially on a week like this, when you have really wild action, you can get a little bit more information from your futures charts than you cannot get, I should say, from the cash market charts. So in the futures charts on the ES, what I thought was most interesting, for lack of a better word, is the break of the trend line from here. You have this uptrend going on, and you breach here and rally back, and then here you get this 3-day rally I was talking about where you break the downtrend. We just looked at that in the cash markets. And when we came down Thursday, Friday, look at how we breached on Friday, but carry this forward in your narrative because it's important that the ES did not get as low as this pullback low, right? So that 6655.50 is basically your key downside reference in the futures. If we lose that, forget it. We could seriously move a lot lower. But right now we're sitting on back-to-back reversals in the futures with huge buying tails off the bottom. Again, if we get a turn that revisits these areas, something very, very important to note is that when signals like this stack, they are exponential and not linear. That means that it will be an extremely powerful short signal if you move below those bars because those lows are relatively equal, and both of those days were reversals, right? Let's look at the same exact thing in the NDX. This is NASDAQ futures. Big differences, and again, mainly because the technology leverage cuts both ways, right? When it's good, it's real good, but when it's bad, it's real bad. And you see the relative weakness in the NASDAQ, how the NASDAQ futures took out the low. I purposely annotated both here. So you have 24,709, right? And then the 24,626. Those are your two lows in the futures. Again, Friday was a little bit weaker, took it out. More importantly as well, we talked a little bit about the pinch in the cash markets, how it's almost happening in the NASDAQ 100, right? And this is why I wanted to spend a few minutes on the futures chart, adding it on, because look at the pinch. It's happening. As of today, you have a pinch. That 8 EMA is through the 21 on the futures. It just hasn't happened yet in the cash market. So I am definitely carrying this forward in my narrative. This is kind of a big deal that the NASDAQ 100 is pinching due to the increased volatility, I think, in the NQs, which tend to be a bit wilder than the ES. It makes perfect sense that we're seeing the pinch first. So I'm going to keep monitoring this over the course of next week, see if that if we stay pinched, see if that ES pinches, and then see if we get any follow through from the cash markets also pinching, quote unquote, as well, taking those 8 EMAs down through those 21s. In keeping with the very chart-focused theme of this show, I thought we'd do the charts to watch segment today because I have a lot of charts that I want to show you that I think are going to be in play for the week to come. All right, let's take a look together. I want to start out with gold here because as we talked about in the week in review segment, gold is very sensitive to interest rates, right? Gold likes it when rates are low and potentially going lower. And that news that we got this morning, which is a little bit hawkish, taking the odds of that December cut lower also brought gold down quite a bit. And you can see here on the daily chart, this was the bar in question that we just had on Friday. So what I've done here with the gold is I've put an anchored VWAP on it, which is really a fantastic way to look at charts on a slightly longer term basis. I find that these anchored VWAPs work really, really well on daily charts, 3 months, 6 months, etc. And what I've done here on these gold futures is I've put the anchored VWAP from the breakout low, which was September 2nd, 25. If you go back on your charts and you look, you will see that that was that 3,600 level where gold broke out in early September. And since then, the volume weighted average price of all the transactions in the gold futures that have occurred since then is right about here, just north of that 3,900 level. And look at how well it's supported here. When we hit the highs here at almost 4,400, where did we come down to? Look, only some small shadows lost that VWAP. So going forward, this is a very key level that you should be playing against. I think gold should still be under accumulation on any backoffs to this area. This is probably just a blip in the chart. Remember, even though the interest rate situation may be changing, which gold doesn't like, the debt situation is not changing. And the uncertainty and everything else that goes with it is not changing, and that to me is the thesis here. So this may be a buying opportunity. Again, I think your key level is to be watching that area between about 4,000 and 3,900, where that anchored VWAP comes in around 3,965. If we lose that level, that's really the only thing that's going to kind of change my thesis in gold, is losing that AVWAP. But other than that, between here and there, probably still a buy. All right, let's move on to the next chart. This one is the futures chart of Bitcoin, and I specifically wanted to look at it here on a weekly basis because on this longer term time frame, I can show you these two trend lines from when we started to break here. This is about the 40,000 level down here. And since then, it's kind of been a straight rally with pullbacks along the way, of course. But look at how the trend lines come in, going all the way out here. And there's two of them. The lower one is still intact, which is starting from here. But the main trend line going all the way back to where we started rallying, it broke this week. So there's two things really that are important here in the Bitcoin chart. One, price-wise, you have the psychological loss of the 100,000 level. There was a lot of support there, and of course, that's just a big round number. Everybody kind of keys off that. We're well below that. We're about at least $6,000 below that. Well, we went into the 94s, closed at about just under 95. So that's important. And secondly, this break of this trend line, I think, is important. So my thing is just be very, very careful here. If you're a Bitcoin maximalist or you're just all about Bitcoin, you're trying to buy every pullback, just be careful here and maybe wait for a little bit of stabilization first. See if we can retake that 100 and then take it from there. And remember also, you are generally trading, and it's kind of unfortunate because I think it would be nice if it wasn't, but you are generally trading in a risk-on manner in terms of Bitcoin, right? It's all a risk-on manner. That means that when equities are down hard, usually Bitcoin is going down hard too. We have not yet seen that sort of disconnect where this can be a haven type of asset, so keep that in mind as well if we get more bearishness in the equity markets. All right, let's take a look at the next one. This one here is XLK, and because we're not doing a sector spotlight today, I wanted to bring this in the charts to watch segment because it is, of course, the most important piece of the S&P puzzle. And that's why if you look on the top of the chart here, I purposely wrote 36.1% of the S&P because that's what it is currently, right? This is literally more than a third of the market right here. And let's just take a closer look on the daily in terms of what's going on. So obviously it's going to look very, very close to the S&P itself because it has such a big weight. But again, my main focus is what? On the pinch. It looks like it's just now starting to happen by just a little bit. You're just starting to pinch, and that is important. So in order for this market to really turn around and get further to the upside, you need this XLK to go up. I didn't draw in the trend line here, but it should be pretty obvious to you TA people that you just connect these highs here. And that's going to put the trend line break around 291, 292-ish in the XLK. And these are the areas to watch. And again, very, very important sector. Obviously, the heaviest weight in the S&P is right here. All right, let's look at a couple more charts before we wrap it up. This is Meta. And I'm very interested in this for a potential long-term play, not yet. But first, a little bit of color on what's going on here. Notice that there has been extreme relative weakness in Meta for some time now, right? We had a strong gap down here on an earnings call, and since then it's been straight down. And if you'll notice, there's a huge difference between this chart and the S&P and the NASDAQ, right? Obviously, we've had some big reversals in the broad market, but Meta has not reversed at all. We have not broken course here, so to speak. We're all just straight down, and this is important. Why is this happening? Very simply because they are ramping up CapEx in a huge way in anticipation of what they're going to need for AI, right? So what that is doing, it is depressing FCF, as they call it, free cash flow, and of course the stock doesn't like that. Those of you who have been trading for a while, you will recall that the exact same cyclical nature happened with Amazon many times in the past, right? Amazon would start spending heavily on distribution centers, getting ready to grow their business. Free cash flow would go down, and the stock would cyclically be down. And sometimes this would literally last 6 months, 9 months, even a year. So Meta may be in this exact same cycle. At any given time, they will decide at some point to stop the spending. You will see free cash flow go straight up, and of course the earnings reports will be better after that, and the stock will turn around. So for now, just keep an eye on the downtrend. It's already pinched. It's definitely in a downtrend. You could move lower here. I mean, it could move much, much lower, but at some point there will be an opportunity here. So just keep some powder dry for Meta, I think. All right, last but not least, probably the biggest name in tech, also powering the entire AI trade, of course, NVDA. And why are we talking about it specifically here? Because they are reporting next week. 11:19 on Wednesday p.m. is going to be the NVDA earnings. Let's take a look at the chart here. I purposely put the same anchored VWAP on going way back in here, starting from April 7th, which was a key low. That was that 86.62 reversal there. And if you follow it all the way out here, you'll notice that it doesn't come in until 154.5 approximately. So this is noteworthy because think about it psychologically. What does this really mean? If that's the volume weighted average price from all the way back there from when the stock started rallying on April 7th of this year, that means that all of these people, for the most part, are still above water, right? There's no fear here. Where does the fear start? The fear starts when en masse, there's that sort of flip where more people are losing than winning. But right now, that is not the situation. The anchored VWAP in NVIDIA is not coming in until about 155. So anyway, let's see what happens on Wednesday. Obviously, the whole world's going to be watching this, and that will have effect on the broad market as well. Because remember, this is a market that is extremely driven right now by the AI trade. And this is a market that really wants to get good news all the time and make sure that that trade is continuing to expand. And if there's any sort of talk of even the littlest bit of contraction, I think the stock is probably not going to like it and probably takes the market a bit lower. So all eyes on NVDA next week on Wednesday. I want to do a fundamental take segment in this particular program, specifically this week, because it's all about data. As you probably know, we, of course, are coming off of one of the longest government shutdowns on record. But what that does in terms of traders in the market is also shuts down all of the economic data that we're used to. So Bureau of Labor Statistics, jobs reports, CPI, PPI, all that stuff that we rely on to give us color in terms of the movement for our trading. We haven't had that for a while, and now that stuff is all going to start dumping on the market en masse pretty soon, but some of it might not even be happening at all. Let's take a look at what's going on here in the fundamental take as far as data. So I've just put some notes together for you to see what we can expect. BLS September jobs report, which is the jobs added and the unemployment rate, very, very important. We usually get that once per month. That was originally scheduled for October 3rd, and we're supposed to probably get that in the coming week. Expect that, I think, around midweek. They're saying like Wednesday or Thursday. That's going to be very, very important. September PPI was originally 1016, and now that also is supposed to come for next week. And September retail sales were also originally October 16th, but likely delayed a bit longer. So keep that in mind. Some stuff is happening. It's all going to hit next week, and some being delayed. Let's continue on. October jobs report, originally scheduled for November 7th. Here's where things get a little dicey. Problematic due to the government being closed while the BLS normally collects data. Potentially could be released as an Oct-Nov sort of combined report together in December. So that's important. We might not even get that October jobs report sooner rather than later. And then the October CPI was supposed to come out on November 13th, possibly not coming out at all. And this is unprecedented in the history of all the time that all this stuff has been reported. This has never actually happened before. So this is very, very key, I think, going forward. I would not be surprised if the market continues on this two-sided manner just due to some of this data coming out, potentially surprising people, and some of this data not coming out at all. So as far as from the fundamental standpoint of things going forward, I'm thinking a little bit more uncertainty, but just be aware that these releases are coming. They are going to be dropping, and it's going to be the first time that we're getting some of that economic data in a while, and thus the impact on the markets could be a little bit larger than normal. As we were just talking about that economic data looking ahead, it's also important to look at earnings, right? We do a looking ahead segment each time to kind of wrap up the show. Earnings season is starting to dwindle a little bit, but this week is kind of interesting, this coming week, because there are some big names still reporting. Let's take a look at the schedule here. Home Depot and Lowe's are both happening next week, and that's kind of key because if anything's kind of a barometer of what's going on economically, I would say it's going to be those two. Baidu and, of course, NVDA that we already talked about is going to be the big one on Wednesday as well after the close. Beyond that, Walmart and Intuit, I would pay a lot more attention, I think, here to Walmart. That's kind of a bellwether as well. On Thursday, that's going to give us a lot of information, I think, on the state of the consumer. But again, next week is going to be all about not only this, but that economic data that's going to start filtering out of the government as things get reopened. So that put together with some of these earnings, especially NVIDIA, could lead to a pretty volatile week next week. And that's my show for this week. Thank you, as always, for spending a little bit of your weekend with me. Let's just recap a little bit of what we discussed on the program. From a technical standpoint, very, very important. We might get a pinch, right, in the NDX and the S&P. We already saw a little bit of a pinch on the NASDAQ futures. I would keep watching for that. Regardless of the big reversal on Friday, remember, we are still in a situation where we're starting to make lower highs, and that's very, very important. So there will be some sort of a downtrend, and the market's not really going to change tone unless we change and break up over that downtrend. So keep that in mind. Now, also on the technical level, remember that the name of the game as of late has been sector rotation. So you may want to keep that in mind. I like to tell traders, don't get sucked in to a big move in either direction thinking that there's going to be follow through unless there's buy-in from all of the sectors of the S&P. All of those 11 sectors need to be moving together en masse in order for those big moves to have sustainability. And right now they're not moving together, and that's why we're not getting sustainability of moves. You're getting a lot of action that's one day up, one day down, and it just kind of looks like barcode on the charts. And it makes anything longer time frame than day trading very, very difficult to trade. So keep that in mind. Continue to keep a close eye on those 11 sectors of the S&P and see if things next week start moving en masse together or if we still have a lot of sector rotation. All right, beyond that, remember the economic data is going to start coming. A lot of stuff that we haven't seen in a while. We're going to start to get jobs data, etc., as those government agencies reopen. So keep that in mind as well. All right, as always, if you could, hit that like and subscribe button and also the little bell icon to be notified anytime that Shadow Trader posts new content, which is, of course, every day through our Shadow Shorts program. Next week, we are on hiatus, so we will not have a show next week, but I will be back at the end of the month, which I'm really excited about because it's going to be the end of November. We're going to be talking about monthly charts and seeing how things are shaping up into the last month of the year, which is usually bullish. So we're going to see if the charts are telling us, are we going to get some sort of Santa Claus rally at that time or not? But between now and then, of course, lots of time elapsed. But again, no show next week, but I'll see you at the end of the month. All right, coming at you from beautiful Los Angeles, California. As always, I wish you good trading and good night.